Imagine a scenario where your loved ones inherit a family home or a significant stock portfolio that has grown substantially in value over many years. When they eventually decide to sell these assets, will they face a huge tax bill on all that accumulated gain? This is a common concern for many families. The concept of stepped-up basis is incredibly important because it can dramatically reduce or even eliminate capital gains taxes for beneficiaries who inherit appreciated assets. Essentially, when someone inherits property, its cost basis for tax purposes is reset, or stepped up, to its fair market value on the date of the original owner's death. This means the inheritor receives a fresh starting point for calculating any future capital gains. Now, why does this happen, and why is it so beneficial? The basis of an asset is generally its original cost. If you bought shares of a company for $10 each and they are now worth $100 each, your gain would be $90 per share if you sold them. This gain would be subject to capital gains tax. However, with stepped-up basis, if you inherit those same shares, their new basis becomes $100 per share, which is their value on the date of death. If you then sell them for $105 per share, you are only taxed on the $5 gain, not the original $95 increase from when your loved one first bought them. This rule exists to prevent double taxation, as the estate itself might be subject to estate taxes, and to simplify the tax accounting for heirs who might not have records of the original purchase price decades ago. It acts as a significant relief from income taxes on capital gains that accumulated during the deceased person's lifetime. To make the most of this, inheritors typically need to establish the fair market value of the inherited assets as of the date of death. For real estate, this usually involves getting a professional appraisal. For publicly traded stocks or mutual funds, financial statements or online quotes for that specific date can provide this information. Once the new basis is established, it becomes the benchmark for any future sale. If the assets are sold shortly after inheritance for a similar value, there might be little to no capital gains tax due. This allows beneficiaries to liquidate assets without a large tax burden, whether they need the funds or prefer a different investment strategy. This stepped-up basis rule is a powerful, yet often misunderstood, advantage in estate planning. It is distinct from the estate tax itself, which applies to the total value of an estate before distribution to heirs, only if it exceeds a very high federal threshold. Stepped-up basis, however, relates to the income tax treatment of inherited assets after they are received. It is also a key reason why many people choose to pass assets through inheritance rather than gifting highly appreciated assets during their lifetime, as gifted assets retain the donor's original, or carryover, basis, meaning the recipient would still owe taxes on the full original gain when they sell. Understanding stepped-up basis ensures that your legacy is transferred as efficiently as possible, maximizing the financial benefit for your beneficiaries. It is a critical component of strategic estate planning, allowing families to preserve wealth and reduce potential tax liabilities, ultimately providing more financial security for future generations.